Welcome everyone. This is Pinnacle Professional College. If you haven't subscribed to the channel, kindly do so. Hit the subscribe button and hit the bell icon so that anytime we post a video, you'll be the very first person to get it. So today we'll be talking about agreeing the terms of audit engagement. Agreeing the terms of audit engagement is ISA 210. Now, we need to understand what is the objective of the engagement letter. What is the objective? The objective of the auditor per ISA 210 is accept or continue an audit engagement only when the basis upon which it is to be performed has been agreed. So the engagement letter gives us the basis for the performance of an audit. So you only accept or continue an audit engagement only when there's a basis for performance or when the basis for performance has been agreed. And how is this done? This is done by establishing what we call the preconditions for an audit. Establishing whether the preconditions for an audit are present. So you need to understand, are all the conditions necessary for the audit, are they present? And you also need to confirm, this is about the engagement. So you need to confirm whether there's a common understanding between the auditor and management, between the auditor and management. This is very, very crucial. So that's one of the things that the engagement letter seeks to establish. The auditor is required to refuse the engagement where a limitation on scope is imposed by management, such that he would be unable to express an opinion on the financial statement. So the auditor has a right to refuse the engagement where a limitation on scope. What's a limitation on scope? It's a situation where management restricts the auditor in terms of the scope of activities that they are able to perform in the audits, one way or the other. So they limit scope. That's why it's called a limitation on scope. They limit the scope of the audit work, by either not providing the information that they need, and so the auditor is not able to give their opinion, or some other restrictive measures that makes it difficult for the auditor to express their opinion. Very, very important. Or the financial reporting framework to be used in the preparation of the financial statement is unacceptable. So the auditor can refuse the engagement when the reporting framework is totally unacceptable. The auditor can also refuse the engagement when management does not agree to the above responsibilities. What do you mean by above responsibilities? The correct reporting framework must be used, and the management must also provide evidence. If management does not want to provide evidence, how does the audit work get done? It becomes difficult to be able to do the audit work. So this is very, very crucial to understand, right? This is very, very important to understand. So the auditor can refuse the engagement on that basis. Now, I'm sure you want to know, what is the content? What is the content of the engagement letter? What are the things that are in the engagement letter? The engagement letter must include reference to the following. Number one, which is it should include the objective and the scope of the audit. The objective. What is the objective of the audit? And what is the scope of the audit? Number two, the responsibilities of the auditor. Number three, the responsibilities of management. So you see, the engagement letter gives us an idea, not just an idea, but establishes what the responsibilities of the auditor will be and what the responsibilities of management will be. We need that defined so that everyone knows exactly what they are doing under the engagement or under the audit. It's very, very crucial. Very, very crucial. It also helps us to identify the underlying financial reporting framework. It's very, very key. It's very, very key. So these are some of the contents of the engagement letter. These are some of the contents of the engagement letter. So you see that the engagement letter is a very, very key document when it comes to audit work. Now, let's look at the annual review of the engagement letter. Responsibilities change here and there. And so the engagement letter sometimes has to be reviewed. So the engagement letter that is issued on the initial appointment of the firm as auditors may specify that its provisions will apply to all future audits until it is revised, So at the beginning of the audit, when an auditor is appointed, there's an engagement letter, and this engagement letter will sometimes say that the provisions therein apply to all future audits until it is revised. However, ISA 210, which focuses on audit engagements, requires the auditor to assess whether there are circumstances that, that make it necessary that the audit engagement be revised. So maybe things might come up, new things come up, and we need to understand whether these new things affect the audit engagement letter in any way. It's very crucial. It's very crucial. It's very, very important. Now let's talk about acceptance of a change in the terms of the engagement. The entity might, in certain circumstances, ask the auditor to change the terms of the audit engagement. So there are situations where there might be a change in the audit engagement or in the terms of the audit engagement. This might result from a genuine change in circumstances. So you see the things that trigger a change in the terms of the audit engagement. It could be a change in circumstances or from a misunderstanding as to the nature of an audit as originally requested. However, it could also result from a situation where the auditor is unable to obtain sufficient appropriate evidence regarding a material item. So what some clients do or some entities do is that they might ask the auditor to change, or they might ask for a change in the audit engagement terms to avoid a qualified opinion or a disclaimer of opinion. So ISA 210, because of this tendency of entities or clients, ISA 210 suggests that the auditor considers the justification for such requests. Is it reasonable, in terms of changing the terms of the engagement? Is it reasonable, or the entity is finding ways to avoid a qualified opinion or a disclaimer of opinion? If the auditor considers that it's a reasonable request, then revised terms should be agreed and recorded. So if it's reasonable, fantastic. Then the terms can be amended. If the auditor is unable to agree to a change of terms, he should withdraw from the engagement. So if the auditor is unable to see the reasonableness of such changes, he should just withdraw and consider whether there's an obligation to report the matter to those charged with governance. It's very, very crucial. Very, very crucial. Very, very crucial. So let's move on to, since we've established audit engagement, let's move on to what we call audit strategies. Audit strategies. So I'll lay the foundation on audit strategies. Then in subsequent lectures, we would touch a lot more into detail when it comes to audit strategies. And audit strategy is basically the overall approach. Is the overall approach that the auditor decides to take for an audit. Is the overall approach that the auditor decides to take for an audit, from which a detailed audit plan can be developed. So the audit plan flows from the audit strategy. The audit plan flows from the audit strategy. Very, very important. Very, very important. Several possible audit strategies are available. Number one, a business risk approach or risk-based approach. A business risk approach or risk-based approach. These are all audit strategies. So we'll be diving into it in subsequent lectures. Then you have a system-based approach. You have a substantive testing approach. And you have a statement of financial position approach. Usually, and this is usual for small entities. It's very, very common for small entities. Very, very important. Very, very important. Now, let's look at a brief summary of all these approaches. Now, what is the statement of financial position approach? This audit approach concentrates on the statement of financial position figures using substantive testing. And this is the argument. The argument is that if opening and closing statements of financial position are accurate, then the profit or loss for the year must also be stated accurately. So that's the assumption here, right? The assumption is that if the opening and closing statements of financial position are accurate, then the profit or loss for the year must also be stated accurately. And this is usual for small entities, as we already explained. They have substantive testing. And this is what we call test of details, of test of balances, or test of transactions. So this approach focuses on applying substantive tests to a larger number of transactions and account balances recorded in the accounting system of the client. So you see, that's what we are talking about here. Then you have the system-based approach. This approach focuses on applying substantive tests to a large number of, the system-based approach, it focuses on the application of test of controls. So system-based approach, you are talking about control systems. Control systems, similar to internal control testing. So the audit focuses on the application of test of controls to the systems that produce the figures in the financial statements. So you see here, you are looking at the controls that produce the figures in the financial statements. So here you are looking at internal control testing. You have the risk-based approach and business risk approach. This here is more of an assessment being made of the likelihood of material misstatements existing in each area of the audit. In each area of the audit. Areas that are assessed as high risk are audited extensively. So if an area is identified as high risk, then it makes sense to audit it extensively. Areas that are identified as low risk are given a low attention in the audit. So again, we have all kinds of audit strategies. Number one, we have the statement of financial position approach. We have the substantive testing approach. We have the system-based approach. We have the risk-based approach. All of these are strategies that can be used and applied to the audit. So in the statement of financial position approach, the audit approach concentrates on the statement of financial position figures using substantive testing. It uses substantive testing, but the argument here is that if the opening and closing statements of financial position are accurate, then the profit or loss must also be stated accurately. Substantive testing is more of test of details, test of transactions, test of balances. System-based approach is more of testing internal controls. Risk-based approach is assessing the likelihood of material misstatements. So that's a typical summary. This is where we bring today's lecture to an end. You can join us on Telegram at Pinnacle Professional College. Thank you and have a good day. Bye.